In today's economic landscape, soaring rents has become the norm rather than the exception. Cities across the globe are witnessing a sharp increase in rental prices, making it seemingly a golden era for landlords. After all, higher rents should translate to more money in the bank, right? Surprisingly, that's not the case, and despite the lucrative rental market, many landlords are choosing to sell their properties. But what is it really that's driving the landlords away? And could it be that the glittering world of high rents is not as lucrative as it seems? 1. The demand-supply imbalance. The rental market is a complex ecosystem influenced by various factors, and one of the most critical elements is the balance between demand and supply. While it is easy to assume that high demand for rental properties would be a boon for landlords, the reality is far more nuanced. The demand for rental properties has indeed been on the rise, driven by factors like job growth and migration. However, the supply side of the equation has not kept pace. According to some sources, there was a 19% drop in the number of properties available to rent compared to previous year. This has led to a 57% rise in the mismatch between rental supply and demand. The imbalance is not just a statistical anomaly, it has real-world implications. For instance, the lack of supply puts upward pressure on rents. While this might seem like good news for landlords, the reality is that higher rents don't necessarily translate to more profits. According to a survey, 62% of agents reported rents increasing month-on-month at their branches. However, this is down from 68% in May 2023 and 80% in June 2022. This suggests that while rent may be rising, the rate of increase is slowing down, which could be a sign of market saturation or tenant fatigue. The imbalance also has a cascading effect on the market. As more landlords decide to sell their properties, the supply of rental properties decreases even further, exacerbating the existing imbalance. This is a vicious cycle that shows no sign of slowing down. More importantly, however, the imbalance is not just a temporary blip, but a structural issue that requires a comprehensive solution. 2. Mortgage woes. The financial aspect of being a landlord has become increasingly complicated due to rising mortgage rates. According to data from the Office of National Statistics, the rental market in the UK saw a 4.4% rise in private rental prices in the 12 months leading up to January 2023. The increase has presented landlords with a multitude of challenges, including the sudden surge in interest mortgage rates. As these rates climb, the monthly mortgage payments that landlords have to make also rise, putting a strain on their cash flow and overall profitability. But that's by no means the only problem at hand. Higher rates can also affect the overall property market, including property valuation and buyer demand. When mortgage rates go up, it can slow down the property market, affecting the market value of rental properties. This is a significant concern for landlords who may be considering selling their properties. Another angle to consider is the tenant's perspective. If tenants find it challenging to meet increased living costs due to higher interest rates, they may struggle to afford higher rental payments. This can lead to tenant turnover or longer vacancy periods, which can further erode a landlord's rental income and overall profitability. Thus, the financial well-being of the tenants is a crucial factor that landlords need to consider, especially in a market where the cost of living is continually rising. 3. The taxing issue. Up next, taxes are a significant part of any business, and the rental market is no exception. Over the years, various tax changes have made it increasingly challenging for landlords to maintain profitability. One of the most impactful changes has been the removal of tax relief on mortgage interest payments. Previously, landlords could deduct the cost of mortgage interest from their rental income, thereby reducing their taxable income. However, this relief has been phased out, leaving landlords to grapple with higher tax bills. Another tax change that has affected landlords is the increase in capital gains tax. When a landlord sells a property that has appreciated in value, they are required to pay capital gains tax on the profit. The rate of this tax has increased, making it less appealing for landlords to sell their properties. However, the catch here is that not selling might mean dealing with other financial burdens, such as the aforementioned loss of mortgage interest relief. Additionally, there are other less obvious but equally impactful tax changes. For instance, the wear and tear allowance, which allowed landlords to deduct the cost of maintaining their properties from their taxable incomes, has been replaced with a less generous system. Now, landlords can only deduct actual costs incurred, requiring meticulous record-keeping and potentially leading to lower deductions. The cumulative effect of these tax changes is significant. Landlords are now faced with a situation where the costs of maintaining a property, coupled with increased taxation, are eating into their profits. Thus, selling now really seems the best bet. 4. The fear of market crash. Imagine investing in what seems like a gold mine, only to discover that it's a ticking time bomb. That's the dilemma landlords face due to the looming threat of a housing market crash. But it's not just about fluctuating property values. It's a cocktail of risks that makes the situation dire. Experts have been warning that property values are overvalued, creating a bubble that's waiting to burst. Now, you might think, so what? Bubbles burst all the time. But here's the kicker. When property values plummet, landlords could find themselves owning real estate that's worth significantly less than what they paid for it. Imagine buying a shiny new car only to find out that it's worth half the price the next day. Insurance companies are adding fuel to the fire. Major insurers are already pulling out of high-risk areas, making it harder and more expensive to insure properties. If you can't insure your property, or if it costs an arm and a leg, that's a financial burden you didn't plan for. And let's not forget about long-term consequences. Once the word gets out that the market is risky, property values could take a nosedive. In extreme cases, some properties could lose almost all of their value based solely on skyrocketing insurance costs. 5. Uncertainty in legislation. Last but not least is the legislative changes, yet another driving factor behind landlords' decisions to sell their properties. The landscape of landlord-tenant laws is continually evolving, and the uncertainty this creates can be unsettling for property owners. One of the most talked about legislative changes is the Renters Reform Bill. This bill aims to end Section 21 evictions, making it more challenging for landlords to remove tenants without a specific reason. While this is seen as a positive step for renters, it adds another layer of complexity for landlords. Another legislative change that has landlords on edge is the focus on energy efficiency. New laws are being introduced that will require rental properties to meet specific energy efficiency standards. Failure to comply could result in hefty fines, making it another financial burden for landlords to consider. The cost of upgrading a property to meet these new standards can be significant, and for many landlords, it's a cost they are not willing or able to bear. Moreover, there are proposed laws concerning pet ownership in rental properties. Legislation like HB 23-1068 aims to make it easier for tenants to have pets, which could potentially lead to more wear and tear on the property. While many landlords are pet-friendly, the possibility of legislative changes that could make pet ownership more common is another factor that adds to the uncertainty. The legislative landscape is not just changing at the national level, local laws are also evolving. For instance, some areas are considering rent control measures, which would limit how much landlords can charge for rent. While this is aimed at making housing more affordable, it directly impacts landlords' potential earnings. The constant flux of legislation makes long-term planning difficult for landlords. The rules they must follow today may not be the rules in place a year from now, and this uncertainty can be stressful. For many, it is the final straw, pushing them to sell and exit the rental market altogether. If you liked this video, please consider subscribing and sharing so we can keep bringing more content like this. See you next time.